Coming up on Market to Market, producers and packers have a stare down over profits. Milk producers take it on the chin as consumption hits a brick wall. The ripple effect of a change in the food supply chain.
Stuff that goes on.
Market analysis with Tomm Pfitzenmaier. Next.
In the end, I just don't think we
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.
This is the Friday, April 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. 2 U.S. packing plants closed temporarily this week after workers tested positive for COVID-19. The great majority of packers continue to run. New protocols have been put in place, including slower chain speeds, frequent cleaning, social distancing, and barriers between workstations. Even before the pandemic, some cattle producers were upset with the disparity between consumer prices and paychecks from the packer. Colleen Bradford-Krantz has more.
Tyson Fresh Meats temporarily suspended operations at its Columbus Junction, Iowa hog plant after more than 24 workers tested positive for COVID-19. JBS USA halted beef processing at its Souderton, Pennsylvania plant until April 16th after senior managers suffered flu-like symptoms. Those plants still operating are often doing so at reduced speed as they stop for more frequent cleaning and add either social distancing or barriers between workstations. The slowdowns and shutdowns came as most Americans shifted food purchases to retail outlets instead of restaurants, schools, or work cafeterias.
Early in the outbreak, when the restaurants were closing, we saw a run on beef in the grocery stores, and so actually box beef prices increased by a significant percentage. So that gap between what the producers were seeing, which tended to follow the futures in terms of their prices, and the box beef prices has been historically large.
Eric Nelson, a Mobile, Iowa cattle producer and Midwest District Director for the advocacy group RCAF, said the consolidation of the packing industry has left cattle producers with fewer places to sell their animals.
It's like if you were going to have an auction of all of your household wares or your house, you want to have as many bidders show up at an auction as absolutely possible.
Senator Charles Grassley, a Republican, is calling for an investigation under the Packers and Stockyards Act to see if there is any market or price manipulation.
Last August, there was a fire at a large plant in Holcomb, Kansas, that actually did the same thing to the markets. This is not a short-term problem. There are some short-term symptoms since the COVID virus, but the deeper problems have been endemic. They've really been coming at us strongly for 5 years and really for another 15 years before that.
Tyson offered cattle suppliers a premium for those animals delivered the week of March 23rd, saying in a statement, "This is an uncertain and unprecedented time where food service beef demand has come to an immediate and virtual standstill, while retail demand has increased. We rely on and are concerned with the success and sustainability of our long-term independent cattle suppliers and want them to succeed." Iowa State University's Dr. Dan Loy says there has been growing discontent among cattle producers.
There's frustration with the packers, with the situation in the industry, especially our smaller producers that may only market seasonally. And if they're seasonally marketing this time of year, they're going to be impacted to a greater extent than others.
Congress has recently approved payments to cattle producers suffering losses due to COVID-19.
You know, if we can get our way through this, you know, the outlook is really quite good for the beef industry.
For Market to Market, I'm Colleen Bradford Krantz.
Americans staying at home to avoid the COVID-19 virus have shocked the economy as a whole. Dairy producers have been caught in the middle as demand has collapsed. With sales of milk and cheese have jumped in grocery stores, it hasn't been enough to offset the huge cutback of purchases by restaurants. According to the American Farm Bureau, wholesale dairy prices have dropped 26% since January. Peter Tubbs reports.
Been a little bit of a roller coaster ride.
Tony Pesca is a Wisconsin dairy farmer who has been treading financial water for almost 5 years as dairy prices have flirted with profitability. But this month's drop in demand is changing his feed plan for the year.
Just yesterday, we had to change our whole cropping scenario over. We're going to hold our corn and run it through the cows and plant just enough to get our cows through.
The sudden cut in demand was also a surprise for dairy processors.
Anything that is not a consumer package size has dropped about by 65, maybe 70%, depending on the item. So huge drop.
Surplus milk can be processed into cheese in the short term, but that cheese can't make up for a long-term decline in demand. While the sales of dairy products have risen at grocery stores, the rise can't make up for the cutback in other parts of the food economy.
We consume more of all of those products in the home, but in total, the gains from in-home eating do not meet the losses from out-of-home eating. There's just a greater density of dairy product that's used in a meal when we're eating out of the home, more cheese, more butter.
Bauer and the members of the Ellsworth Cooperative Creamery are facing some tough decisions.
We have sent a notice out to our farmers that we're looking for a 7% drop in milk by April 15th. We have cranked up our plants to 100%. After April 15th, we'll probably have to start dumping some milk.
Stevenson says to avoid dumping milk, the industry is going to have to reduce production, and culling the herd is the quickest route to that goal.
This, I think, is going to give us a big enough price drop that we may see that we take cows out of herds again, and that could be the solution.
Bauer agrees and has opened the door to their members.
We are offering those farmers that want to exit early and have their cows exit the milking market by the 15th of April. The board has committed to paying 100% of their equity as an incentive to sell their cows. We have about 4 or 5 farms that have signed up for it already.
We thought about it. Of course, it's just not right for us right now, but, it's still in the back of our mind. I'm sure it's in the back of everyone's mind. We get it on both ends. Our price is reduced and the stuff we need to sell isn't worth anything.
For Market to Market, I'm Peter Tubbs.
USDA data shows Americans spent close to $280 billion on food prepared away from home in 2018. But those stats have already been turned on their head. Vegetable producers across the country are either plowing under some of their product or leaving it to rot in the field as their market dries up. Even where that food is delivered has been in a state of change. I spoke with University of Arkansas agricultural economist John D. Anderson about new challenges in getting food from gate to plate.
But we have had a major shift in how we consume food and where we consume food, and it's taken the supply chain a while to catch up on that. And the primary issue there is that, before COVID-19, typically we would get, numbers vary, but say from 40 to 50% of our food would be consumed away from home. Restaurants, food service, institutional kind of outlets. Now nearly all of it's being consumed at home, and we're buying it at the grocery store. And our processing plants and our retail outlets and really every part of the supply chain has had to adjust to try to shift that production, to try to optimize away from that, 40 to 50% being in restaurants to now all of it going through the grocery store. And that's created some bottlenecks. And so to the extent that we see shelves that are a little light, that's primarily what's going on. Not a real shortage, but a disruption in product flow.
Let's move ahead 2 weeks, 4 weeks, 6 weeks. We've done all this work to get everything switched to the grocery store. And we've heard it. The thought is on commodities. Once we get out of this, it's going to spring and go forward. We're going to have an itch to get outside. What's going to happen to the supply chain then when this gets on the other end of it?
I mean, that's a good question. I mean, will we get kind of whipsawed the other way where we need to suddenly move a lot of stuff back to food service optimization away from grocery store optimization? I think some of that could happen. I think some of that is probably inevitable. I think that'll probably be a little easier to manage because I think that'll probably be staged in gradually a little more than the transition initially was, and so I think it'll be manageable in a way that maybe this first step wasn't or was more difficult.
We just don't know so many parts of this right now, but we're just trying to, I guess, keep that as even flow as possible.
We are, and I would say one thing I would say that I think we all need to take note of is, given how quickly this disruption developed, I really do feel like our system has been very resilient. The adjustments that have been made by retailers, by processors, adjustments that affect everything down to the farm level. But I haven't seen completely empty shelves yet in the grocery stores that I've been in, and I've actually been in several because for me this is like research for me, right? Like I have to keep up with this stuff. So I've actually been really impressed that as quick as this hit happened and as major as it was, our system really has managed it very well overall.
All right, that's John D. Anderson, professor and chair of the Department of Agricultural Economics at the University of Arkansas. John, thank you.
Paul, thanks for having me.
Next, the market-to-market report.
The WASDE report, rumors of Chinese buying and U.S. farmers returning to the field gave the commodity market something new to chew on. The final session was Thursday because the markets were closed for Good Friday. For the holiday-shortened week, May wheat gained 7 cents and the nearby corn contract improved a penny. The May soybean contract added 9 cents. May soybean meal lost $10.70 per ton. May cotton rallied $3.39 per hundredweight. In the dairy parlor, April Class 3 milk futures fell another 51 cents, another volatile week in the livestock sector with multiple limit days in the trade. June cattle rose $3.53. May feeders skyrocketed 10% or $10.85, and the June lean hog contract held on for a 35-cent rally. In the currency markets, the U.S. dollar index decreased 109 ticks. May crude gave back most of last week's gains to finish down 5.12. COMEX gold bumped up 86.70 per ounce, and the Goldman Sachs commodity index fell nearly 3 points to finish at 272.20. Joining us now to give us some insight is one of our regular market analysts, Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Paul.
This is kind of weird. Forgive me. I didn't brush my teeth because I haven't had to sit next to somebody for a while. So we're apart.
Good distance then.
Good to see you actually in person and that you're well. I'd like to say the same thing about some of these commodity markets. It has been, to call it mildly, volatile to say the least. This week we had another USDA report. This one, how did you come up with Thursday's report? What did you think it was trying to tell the market, any of the commodities?
Well, overall it was bearish, mainly because demand has decreased. Corn, they inappropriately really cut back 375 million on the number of bushels that are going to be used to produce ethanol, which is a main reason why the carryout jumped. Beans, same thing. Not exactly the same thing, but exports were reduced, so the carryout there came out larger. Wheat bumped up a little bit too. So I mean, the demand side of the equation was a problem in that report.
Demand is, like you said, a problem in all these things. Let's go with the wheat first. We're having drier weather in the plains, chance of rain, chance of snow in some parts of that wheat country. Is that having any impact on the market?
There's areas that are dry, although overall, I think the crop condition ratings have actually improved a little bit. So I don't know that the problems in the U.S. crop are anything that's given us some strength. I think the problems in lack of movement and wheat out of Russia, out of the Ukraine, Black Sea region, I think is probably what's given the wheat market a little pop here. I don't really expect that to go very far, especially when you've got wheat $2.50 above corn. It's at some point that you're going to lose your feed component of that part of the demand. So I guess I wouldn't view that as something to get too excited about, and probably something to use as a selling opportunity when you get these kind of bounces.
Well, and cash has actually been a little higher than futures. Is that some of that same reasoning?
That's pulling it along too. Yeah. I don't. And like export sales Thursday morning, they were just another mediocre sales. We really aren't moving the product all that well either. So it's kind of a market that I think we're lucky to have the rally we've had, and probably should be taking advantage of it.
All right, so make a sale or two in wheat. Same thing in corn?
At least wheat has got a price that's decent. Yeah, corn's a whole different ugly animal.
Well, we could spend a full 11 minutes talking about corn. So where do you want to start? What's the ugliest thing about corn? Ethanol.
The energy component of corn. I mean, granted, the virus is an issue and sort of is in the mix here, but really it's the energy side of it that's a problem with crude oil dropping like it has. Certainly the lack of movement of people in the U.S. and gasoline demand plummeting means nobody's buying gas, which means you're not mixing ethanol, which means you continue to, as these producers have produced ethanol, they fill up all their storage, and they're forced to shut down because the product's not moving, and it just all builds up on itself. And it's going to take a while. People are going to have to start moving again, using gasoline before there's much light at the end of the tunnel on that. And it appears that that's going to be a while before that happens.
We're looking at like still 3 weeks before we're going to be allowed to really go anywhere, and even then we don't know if that's going to happen. So
the other issue that's creeping up on us here is that, there's a lot of talk about Saudi Arabia and Russia and everybody sort of agreeing for a production cut in crude of approximately 10, I don't know if this has been finalized at the time we record this, but around 10 million barrels per day. Well, the loss in demand's been 25 to 30 million gallons per day. So even with that cut they're making, at some point, just like ethanol, these gasoline tanks or crude oil tanks are going to get full too. And when that happens, crude oil has a lot of vulnerability on the downside, which just adds to the problem for the ethanol industry.
We don't normally talk about oil futures and prices, but I mean, we've seen below 20. Can we see below 10 in oil?
I don't know if I'd want to get that carried away, but you certainly could see it fall down into the teens. Oof. We hit 19 or 19 plus when it initially started falling, and then bounced up with that pretty nicely. But I think you could fall back into the teens if they don't get something figured out, or if we don't get people moving again.
Just chew through some of that. All right,
Right.
Well, you've answered a lot of Phil's question already, but I do want to take it because of how it refers to the December contract, which gets into another thing you talk about. He's asking, with ethanol demand cratering and with big U.S. corn acres expected, how low can December corn go? As you've said, copy-paste on your newsletter for weeks, if not months, you've been very concerned about the size of this corn crop.
I mean, if you produce 95 to 97, everybody's kind of poo-pooing the 97, figuring that they'll probably see some of that shifted away back to beans. But if you have 95, 96 million acres of corn, and you have a trend line yield, which you almost have to assume, until something actually goes wrong, then we're looking at a 3 billion plus bushel corn carryout. Well, 3 billion bushel corn carryout could very well push December corn futures down the 290 to 310 range. So I think you have to figure that as a possibility. Now, I hear a lot of people saying, well, there's no risk premium in D's corn. Well, if it's at 350 and you think it could go to $3, there's 50 cents of risk premium in there, the way I calculate it. Now, maybe there needs to be more if we have some spring hiccup with weather. But for now, it seems like we've got some premium in the December corn that's going to go away if we have a good crop this summer.
As painful it would be, make a sale on some of that December?
Yeah, I think you want to lightly. You can talk to your blue in your face, but most farmers aren't going to want to sell corn
It's hard to do.
at these prices. I mean, you sell 350 futures and you're looking at 310, 320 cash market, and it's just nobody can get excited about that.
All right, soybeans, have they been tied more to the equity markets than other things, or what's the headwinds on this market?
It seems like it. I think there's also some talk that we may see some slow up in movement out of South America, partially because they're social distancing too. They're not working. There's a fear that their ports aren't going to be able to supply the demand to China that they need. So there's some optimism in the bean market that maybe we're going to pick up a little Chinese demand because of that. It hasn't happened to any great extent yet, but I think that's a supportive factor that's sort of sitting out there.
And go ahead.
And on the other hand, you are probably going to, some of those corn acres are going to shift to beans, probably a few cotton acres shift to beans. So again, they have a trend line yield. You're probably going to see maybe not a burdensome, but certainly not much drop in the carry out in soybeans. So I think beans could drop some more. You get November beans up in that $8.80 to $9 range. I think you'd have to look pretty hard at starting, at least making a few sales for new crop beans.
Spread some things out. All right, the livestock. We talk about limit move up, limit move down, back up. What? Can you make any sense of it?
No.
Can anybody?
No. There's so much uncertainty to it that we're talking about congressional investigations on price gouging, and then you've got cattle backed up, and that's putting weight on. That's not good. You've got the problems in the pork industry that tend to spill over into beef. You've got this demand shifting where you went from a restaurant trade to home trade, and that's a little different structure. Like the guy that was on just before me talked about. There's been a change in the supply chain and the way we consume things, and that's disrupted everything. And then on top of that, you get this fear of plant closings. We already had, a little bit of that in Iowa this week. And if that continues, then that backs beef up even more. So you can see why there's a lot of uncertainty about how to play the cattle market.
There's a way?
Well, I think that the lows we put in this week in the last few days are probably going to hold there. So I think you can buy against it if you're a cattle hedger, for example, and you want to sell futures markets. Well, the best time to do that is when you think the price is high and it's going to go low. The best time to use an option is when it's low. You're scared that it might go lower, but there's upside potential. So I think this is probably a time, if you've been a hedger, maybe you switch some of those futures hedges into put options, open that top side up a little bit again for yourself, but leave the downside protection there. So I guess that's the sort of thing I'd be looking at as a cattle producer.
All right, feeders back up $10, 10%. Is that the top of them as well?
It may be, although the one good supportive thing about this cheap corn is it does tend to help those guys out and give them incentive to finishers to buy those feeders. So I think that should be supportive for that market. Again, I don't see it's going to skyrocket without the futures in the live market going up, but it should be a supportive factor for feeders.
All right, you're not feeding. It's kind of hard to get that excited about the hog market, is it?
I haven't been excited about it for 6 months. I mean, China's buying pork, but they're not buying enough.
They're not buying from us.
We're overproducing it. It's a problem. I mean, we've got really cheap hog prices. Let's not argue about that. That's for sure. And I don't know that the futures market sub $40 is not anything that you want to. It's not a point I don't think where you want to get real bearish. But the upside's probably limited until we get this demand thing straightened out, and maybe cut that back on production a little bit, which is that's in the wind that may be coming here, which will be helpful as we move through the year.
Just like it is in beef and in pork, it's not a simple thing to stop production on the front end of it.
Right. absolutely.
So do you have any recommendation in 15 seconds?
I wouldn't get excited about hedging any hogs or cattle futures down here. I'd be a little patient.
All right, and last question, dollar, is it done? Has it hit its peak?
Maybe for a while.
Okay.
You got to remember the dollar's strength comes from how it sits relative to all the other currencies.
All right, and I have to unfortunately cut you off right there and say, Tomm Pfitzenmaier, thank you so much.
All right, thanks, Bob.
All right, that'll do it for this broadcast portion of Market to Market, but there's still more to talk about. We'll cover it in Market Plus, where we'll answer more of your questions. You can find it on the web at markettomarket.org. And if you are searching for more content to put into your school classes you're conducting from home, then check out Market to Market Classroom. You'll find plenty on the science, technology, and the business of agriculture. Go to markettomarket.org for more. Join us again next week when we'll explore how experts are pushing an old grid system in a new direction. So until then, thanks for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.